Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, kind of a regular guest. He's a very smart guy. We love his brain. Karl Denninger from market-ticker.org, a very popular website. Karl Denninger, thank you for joining us today on USA Watchdog.
Well, thank you very much for having me, Greg.
Now, listen, you were a technology business owner back in the 90s, a multi-million-dollar one. You started it, you ran it, you sold it for millions, I suspect. I don't want to know, but you very entrepreneurial. You are a professional trader, investor. You are a financial writer on market-ticker.org, a very popular site, might I add. And I love having you on because I get the full spectrum here. You have talked to us about Obamacare, but it's not just about whether you're sick or not or how much you're paying, about what the effects of on the economy and how things are going. Let's just start with the most obvious thing that happened last week, and that was yet another delay to part of the Obamacare bill where, between 50 and 100 employees, now they can, phase in these arduous, requirements of health care that Obamacare wants people to have. Let's start with that. What is up with that, and how does that affect anything going forward here with, the health care situation and the U.S. economy?
That's just simply an attempt to push the issue past the 14 elections. I mean, there's really not a lot of calculus that went into that beyond that particular aspect of things. I suspect that if you really get down to it, it's just simply that there were going to be about 50, 60 million people that were going to get canceled, and it was going to happen right about the end of September. So, memories are short in this country, and I tend to call the people the American sheeple because they will do things like vote for 90-some% of their representatives right after they get screwed for $700 billion in TARP. But the idea that you're going to throw all these people in hospitals out in the street, it was, I think, a little bit much for the administration to stomach. So they figure if they do this, since huge percentages of the American population works for small business in some form or fashion, this is essentially a way to unload the pressure. And remember that large businesses already had this exemption. So now we're taking the small business, essentially everybody but entrepreneurs, and exempting them for another year. And that's just simply going to put this out beyond the 14 elections and try to prevent the Democrats from losing the Senate, which is what it looks like is going to happen.
Kay Hagan in North Carolina, I've been predicting for, months, if not a year, poof, be gone. That was when she had a 17-point approval rating in the polls. She's toast. She wouldn't even come and step on the same stage as Obama when he came here a few weeks ago to talk about manufacturing and jobs in North Carolina. She's too busy.
Yeah, well, that's the problem that everyone has right now in the Democrat Party is that these are the people who voted for this. These are the people who made it happen. Remember that originally the law was passed with zero Republican support. And so now they have to live with this. And it's all good right up until you find out that, there's 5% of the population that's benefiting from this. And those are the 5%. And let's face it, some people did and have and will benefit. If you happen to have HIV or some other long-term chronic disease, this law is a gift of tens of thousands of dollars to you. But there is no such thing as a gift when the government's involved. It comes out of somebody else's hide, and that's the 90% of the population that doesn't have one of these terrible diseases. They're the ones that are going to get to pay for it, and that's now becoming evident to everybody as it becomes more and more evident. And the restrictions are closed in to try to keep the cost under some sense of containment, losing hospitals and the networks and doctors and everything else. The people are saying, hey, we got sold a bill of goods here. This was a lie. We're pissed, and we're not going to vote for you.
Listen, and I said this on my weekly news wrap-up, which was, wasn't just Obama. It was the entire Democratic Party. They knew what was in this, and they all lied as a party. I mean, this is big, and I don't mean to overblow this, and I'm not a Republican. I'm an agnostic in terms of, a political agnostic. I mean, I have no religion in terms of political, but I will give the Republicans one thing. They didn't vote for this, but the Democrats lied as a party, and either they read it and knew what was in it, or they didn't, and they didn't care, and they lied. They knew it wasn't Nancy, like, we got to vote for it to see what's in it. They lied as a party. They knew what was in it. And now, but what people don't realize is that even for the people that got this exemption, hey, folks, did you know that your employer portion of your benefit is going to be taxed? Another pay cut for you is coming.
Well, and let's not forget, though, Greg, that the Republicans lied, too. And this is the problem that the Republicans have with this particular issue, is that the foundational problem that we have here is not one of health insurance, because if you have an existing condition and you buy so-called insurance that is going to pay off, what you're actually buying is a payment plan. You're not buying insurance at all. Remember, insurance is something you buy against an unlikely possible future event. If you're already sick, it's not insurance. So the problem here is that the Republicans and the Democrats both have kowtowed to the medical industry for 30, 40 years, and the crazy sorts of monopoly things that they have done. They have given them not only cover of legislative immunity from the Sherman and Clayton Acts, which would have landed all these people in prison several times over by now, but on top of that have then turned around and given them enforcement mechanisms through the government so that if you try to break those monopolies, you go to prison. And this is a really serious issue that people don't want to talk about. And we're not seeing this come from anyone on either side of the aisle. So, yes, the Democrats are the ones that passed this law, but the Republicans not only could have stopped it by telling the truth, but could stop it now by telling the truth. The problem with doing so is that then they have to admit to their own culpability, and they're not willing to do that.
Well, and the truth is that they've allowed these guys to run wild for a long time, and they're, their version, the Democrats' version of the bill is like what the Republicans is on steroids, but still an ugly duckling here.
There's no answer to this problem that doesn't involve dismantling the monopoly protections. And if you do that, the cost of medical care will come down by 80 to 90%. All right. And people look at me when I tell them this, and they act like I've got 6 eyes and I'm Cthulhu. All right. But the truth is that you can find this just by looking around the world. And I'm not talking about third world nations either. You get on an airplane and you go to Japan, walk into a medical center there and pay cash for an MRI. You can have it done for a couple $100.
Not $1,200 or $1,500.
Well, but here's the thing, Greg, and this is the important point. Japan is not a third world country.
Yeah.
All right. People look at situations. I've brought up getting on a plane going to India and having surgery done there. The doctor was trained in America. He's using American surgical instruments. He's in an operating room that is full of American equipment, right, made by the same people that are in the operating room over here in the United States. And the place looks like a palace. It's like a Hilton hotel inside. And you can do that, including the plane fare, for 1/10 of what it costs to have the same operation done here in the United States. And people say, well, that's not fair because people in India will work for pennies on the dollar. That's a third world country. Okay. So why don't you get in a plane, go to Japan, do the same thing? You can't make that argument when I get on the plane and go to Tokyo. All right. So this is the problem we have in this country, is that we have built up a structure that essentially taxes all of America to pay for the development of drugs and procedures and medical instruments and advanced technologies that are then used worldwide, and we pay for it. That's unjust. But that is a system we have designed. Both political parties are guilty of it. They are both active protagonists in this, and neither one of them will stand up and say, you know what? The law says that this is supposed to be a felony, not something we protect. It's supposed to be a felony. We've given you exemptions and special protections, and we haven't enforced the law, and in other ways we've made it possible for this to go on for 40, 50 years. It stops tomorrow. And you can either adjust to that reality, which means our prices come way down and the rest of the world's go up some, okay? Remember, we're 330 million people. There's 5 billion on this planet, all right? So what would be the reality? Their prices will go up 10%, ours will come down 80%. I mean,
yeah.
That's the facts if we were to actually look at this as a leveling mechanism and let the market work, but neither side of the aisle will do it. And so what we've got is a situation where when the medical industry ran out of the ability to ram this down your throat any further, which was what was happening as we came into this whole debate on Obamacare, both sides of the aisle made this decision. They were going to try to do something to make it more possible to extract yet more of your money. The Democrats came up with their idea, and of course this is really just a rehash of what Hillary had tried to do back when Bill Clinton was president. And the Republicans stepped back and said, we're not going to support that because that's blatant socialism. All right? But what they didn't do is stop it by putting the truth out there and saying, here's the solution, because to do that, their patrons get upset with them as well. So they said, well, you go ahead and pass it. Well, here we are. And now the reality of it and the harm is going to have to be dealt with, because I still don't see any side of the aisle or anybody in Washington that's willing to take this thing on. And until we actually get to the bottom of what's going on and stop it, there isn't a solution.
And I gotta, and so there's no solution. So all we're left with is this job killing, economy killing law. And I gotta give you some credit here. I don't know. I've been interviewed for a couple of years, and for at least a couple of years, you've been predicting that this was going to be a disaster. One of the things you told me was, you don't bankrupt the country to give people health care. And this is what you said. And boy, it apparently is pretty disastrous and bankrupting when they're, postponing large, hurry up and pass it, and then so we can delay it indefinitely so we don't take a political hit. But, you have said this is going to be an economy killer. This is going to bankrupt the country. And, we just had some retail sale numbers out at down 0.4% in January, and then they revised, December's lower. And so we don't have a recovery. Tell me the effects of Obamacare on the economy. What's your appraisal of the economy?
The retail sales numbers are much worse than they first appear. This is a report that has huge seasonal adjustments in it, especially around this time of year, because there's this funny holiday called Christmas that happens in December. Okay. I mean, who would think that would happen every year, right? I mean, how long have we been celebrating the holiday, right? So there are very large seasonal adjustments, and there are very large drops in retail spending that happen every year on an unadjusted basis. That means tampering with the adjustments, or just plain getting them wrong, even if it's unintentional, can have really big differences in terms of the outcomes that you report. So what I did was I looked at December to January 2012 to 2013, the drop that happened then on an unadjusted basis, raw data, against the drop that happened this time on an unadjusted basis. Again, raw
apples
data.
to apples. You're comparing apples to apples.
Right. I'm looking at the unadjusted figures from December to January in both years. And the drop there was enormous. It's not a couple of percent. It's more on a percentage change basis. It's near double digits. So we have, it literally went in the toilet. Now, a very large part of that was automobiles. So one of the challenges we have right now is how much of that is sticky. All right, how much goes on into the next months, and how much of that was due to pull forward demand in December. And so there's an averaging thing. And vehicles are a tricky business to try to forecast, because they're both very seasonal and they're subject to a lot of game playing. There's a lot of channel stuffing that goes on by manufacturers. The reporting is only on final sales, but builds take place first and then they go on lots. Okay, there's a lot of game playing in those numbers. And it gets really difficult, especially at economic turning points. Back in 07 and in the latter part of 06, just before everything came apart, there was a lot of channel stuffing going on by General Motors, Ford, and Chrysler. And of course, that ultimately bankrupted General Motors. So, there's a question now as to whether or not we're getting the same sort of cycle, and that's happening. We won't know probably until April or May, which means I won't really have a read on this that's straightforward until roughly June this year.
But it's not looking. But it's not looking good.
It doesn't look good, Greg.
You look at the same setup pattern you're saying that happened in 07 before, the financial meltdown.
Yeah, the problem is I don't know how much of what I saw this last month is going to carry forward outside of automobiles, okay? And the thing is that in order to understand the severity of it, I need at least another month or two's worth of data. The problem with waiting the month or two, if you happen to be an investor or trader, is you're going to be right in the middle of the slop at the point that it becomes apparent to everybody, and it's a little late by then. All right, so when I look at that, I look at the retailers' earnings reports that have come out and the sort of top-line misses that we're seeing. I'm a little concerned here because profitability is, as a percentage of GDP, corporate profits are at an all-time high, And the oscillations over the last 3 cycles in that regard have grown in size. So we've had a amplifying boom-bust sort of mentality going on here between corporate profits as a percentage of GDP. We're now up at the top of the range again. We've gone past that, and we're about at the same amplitude of overshoot that we were the last time. So, and again, part of the problem with trying to interpret this data is that it's always in arrears. And in the case of GDP and these corporate profitability numbers, they're 3 months in arrears. So I'm looking at data from the third quarter of last year, because we don't have the fourth quarter numbers yet for GDP as final, and we also don't have the profitability numbers as finals. And then we're going to get the first quarter, preliminary reads. All right. So, all this data is behind. Same thing with credit numbers. The Fed Z1 is always 3 months in arrears. So I'm always looking at things in the rear view mirror when I see this, and then I have to take things like the retail sales report and try to bring that forward into today as opposed to what I know as fact. So what I am seeing here is either, and God help us if people are actually reacting to Obamacare already, because if this is not just a slowdown in the economic cycle coming out of the hot money flows coming out of emerging markets, which we've also seen a huge correction, for example, in the Nikkei and in the Chinese markets and in other emerging markets. If this is actually Obamacare and that pass-through into the American consumer hasn't happened yet, we're in a lot of trouble. My estimation is that we've got some of it, that there's a mixture of this at this point, because everybody anticipates effects. If you tell me that my taxes are going up this year, and that's what everybody's hearing, right? Effectively, Obamacare is a tax. That's how it acts on the American public. So if you tell me that my taxes are going to go up this year, that I'm going to have to pay next year, I am going to reduce my taxable impact to the extent that I'm able and still maintain what I need as a standard of living. As an employer, that means I hire fewer people, I pay them less, and economic activity slows. Anytime you see an increase in tax rates, that's what tends to happen. You get legal avoidance to the extent that people can do it.
I will tell you that on my site, and maybe this is just anecdotal evidence for you, but I ran a poll since December, and the poll said just simply, do you think your health care will go up in 2014? And the answers were yes, no, the same, or I don't care. And right. 96% said, oh, yes. And there was 1,600 respondents to this poll.
Yeah, this is
96% said, oh, yeah, my health care is going to go up. That was, I thought, whoa.
Yeah, Greg, and that's one of the problems is that I've looked at the impact of this, tried to take a fair view of what the actual impact on spending is across the economy. It looks to me like somewhere around $1,000 to $1,500 a family in additional shifting of cost into healthcare from other places. And, that will not come out of GDP because GDP counts healthcare. Okay. So it isn't going to depress GDP, but it's going to come out of everything else. And the problem with
houses.
And the problem with stock prices and the markets in general is that what do you pay for? You pay for profitability. If I don't go to the store, you can't make a profit. You didn't sell me anything. So, this is, when I take all these things and put them together, we've had an extraordinary last 4 or 5 years coming out of the 2009 lows. But it's my opinion that we've overshot on the premise that all the good things were going to come from what the government's done, what the Fed has done, none of the bad. Well, it doesn't work that way, Greg. There's a yang to every yin, and yet there's been no integration of the yang on any of these programs. The decline in spendable income from fixed income investors that is inexorably part of QE, that hasn't been factored into anybody's estimates. The decline in spendable disposable personal income on discretionary goods that comes from shifting that into mandatory healthcare spending, that hasn't been factored into anybody's projections. I mean, where do people get the idea that we're going to continue to see this acceleration in earnings growth and generally economic improvement and expansion, especially in the area of hiring, okay? Which is where the real problem is right now is that real wages in inflation-adjusted terms are stagnant. How do you get there? People, it's the old Ford problem. People have to be able to buy your cars.
This is a pretty dark appraisal of what's coming down the pipe, and my question, I told you in the pre-interview, what do you think the economy looks like in November of 2014? Just a guess, with no, just anecdotal evidence of what's going on. What do you think it looks like in 2014, November?
I will be very surprised if we put a third quarter GDP print up higher than 2%. I'll be shocked if we are materially over 2 for the first quarter, given the revisions that I've seen so far. Everyone's been looking for 3 to 3.5. Okay, I think they're crazy. I don't know where they're getting their drugs from, but somebody's been smoking too much of that legal Colorado dope, because I just don't see it in the numbers. I don't see it in the employment data. I don't see it in the retail sales numbers. I don't see it anywhere that suggests that we're going to be putting up 3% plus, 3.5 GDP numbers for first quarter. Frankly, with the revisions, I think we're slightly under 2 now with what we saw in the retail sales report. We get another bad report for February, and I think we're at 1.5. All right. And so then what do you do from there? Because if all of this so-called expansion has been from hot money, you could print negative by September very easily.
We could have negative GDP. Well, if you take a look at the Fed's own inflation numbers at 2% and hold it up against a 1.5%, isn't that a negative 0.5%? I mean, isn't?
Well, yeah, but that's the Fed's numbers, Greg. Look, you can't use.
I'm just using the official numbers. I mean,
yeah. The problem is it doesn't work like that in the real world. Okay, what I always look at and what I've always graphed and I put up every time I get the Z1 is economic expansion versus credit expansion, because credit is dilution of the currency. That's what it boils down to. It spends just like money. So if you want to know if you're getting ahead or behind, you want to look at income and economic expansion, those two things, versus credit expansion. And that tells you whether or not people are actually making more, they're being more productive and keeping more of their money, or whether we're just simply putting it on the credit card and saying, charge it, let me have it now, I'll pay for it never. The problem with the latter is that eventually you hit the wall on acceptance. People either can't take out more loans, or nobody believes that they're going to pay, and they won't give them more loans. And it doesn't matter which it is. You need both willing and able borrowers in order to continue that cycle. That's how we got in trouble in 2007, is we had a couple little hedge funds that blew up. Remember the Bear Stearns thing back in 2007? 2 little teeny tiny hedge funds went boom, and people sat up and said, I don't think these guys are going to pay their mortgages. And the entire world came apart on that expectation. Now we've blown an even bigger credit bubble, but it's not centered in houses now, although it's starting to show up there again. It's in student loans, it's in car loans, it's in credit card debt. It's everywhere across the economy, and most dangerously, compared to what we had before, it's also in corporate finance and the engineering of balance sheets to pay dividends and buy back stock. Buying back stock with borrowed money sounds great as long as the price keeps going up. But what happens when you pay $400 a share for your stock as a corporation, and then 6 months later it trades for $200? You paid $4. Right?
Yeah.
You flush $200 a share down the toilet, and that money has to be paid with interest out of future earnings. So, to do it out of capital that you retained because you made the money is in some cases defensible. Where it's not defensible is when you borrow the money, because if your stock price does not continue to accelerate to the upside, then you have not only the loss of interest that you have to pay on the borrowed money, you have a capital loss on the acquisition of the shares that you put into the treasury. Nobody accounts for that possibility. So essentially you're making a bet on the come that that's not going to happen. Well, that's a nice sentiment. What goes up never comes down.
And what you're painting the picture is that we have a similar setup to 2007, only worse. Is that right?
It's broader, but less sharp. Okay, that's the way I would look at it. The 2007 collapse happened because of derivative exposure that was uncapitalized. And when that became, look at what happened to AIG. AIG wrote nearly $1 trillion worth of derivatives with something like, what was it, 50 billion in capital or some stupid amount of, essentially zero for all intents and purposes, right?
Yeah.
200 to 1 leverage. Fannie and Freddie were geared 80 to 1. And as soon as that got exposed, even though it was a huge part of the economy, in dollar terms, it wasn't that large an amount of money. All right.
And now?
But because of the amount of leverage that was implicit there and the fact that people can claim on those notional when, look, if I bought an insurance policy from you and says you're going to pay me $10,000 if this thing defaults, if it defaults, you owe me 10 grand now. All right. Here's your defaulted bond. Give me my money. And then you get to go try to recover whatever you can off the defaulted instrument, which could be anything from 0 to some percentage of the face. Well, if you don't have the $10,000, okay, because you have to be able to give it to me now and then go back and try to collect. That's what blew up the world. What's happening now is much more diffuse. It's much wider because it's across both personal balance sheets and, more importantly, corporate balance sheets, but it's not as sharp. So I don't expect the same kind of disaster that we had with compounding, cascading failures. The danger is that I'm not at all sure that that's not true outside the United States. In other words, I don't see that kind of point source risk in the U.S. Where I think is very possibly present, though, is in Japan and China, as well as a number of other emerging markets. And
either one of those countries could take us down, could take the whole
world.
Well,
if it happens overseas, it will come here because the interlocking connections between institutions have not been decoupled at all, and the too big to fail paradigm is still present, and we still have a crazy amount of exposure over there. So I don't think that the risk is diffuse, but more severe in the United States. The point source kind of risks are overseas at this point. And by the way, they're in Europe as well. So, there's a possibility that the triggering event comes from over in Europe, although frankly, I think it comes out of Asia.
Well, let's talk about Janet Yellen for a bit. Her first, meeting, and this is one of my questions. I wish somebody in Congress, which to your point shows that both sides sell us out. And simple question, and that is, Ms. Yellen, we're $65 billion in funny money, which everybody's happy about. We're only spending $780 billion to prop up the economy a year, but half of that is $30 billion to mortgage-backed securities, which go to the big banks, basically. And my question is, okay, Ms. Yellen, which banks are getting $30 billion a month? And nobody will ask that. That's $360 billion. They go to the mat, both sides, on $85 billion sequester for the year, and you don't want to know where $360 billion is going. My question to you then is, she's talking about you're going to keep the taper intact, and we have 0% interest rates, and tapering's not, contraction of liquidity, and is she going to get stuck in a situation where she's going to have to do an about face on this taper and start pouring more gasoline on the fire?
No, she can't.
She has to taper.
The taper wasn't a choice the Federal Reserve made. Taper is coming about because the inexorable reality of quantitative easing and low interest rates is that the world is a balance sheet. And the dollar you don't pay in interest is the dollar I don't get in interest income. Now, eventually, because of the way duration matching works, as those portfolios roll off and get replaced, that impact comes on slowly, but it comes on inexorably. To have a quantitative easing policy that lasts for a year or two is potentially supportable because the damage is diffuse. If you've got a 20-year duration on your portfolio, as an example, and you take on this QE program, 5% of that damage gets accrued to you in the first year because that part rolls off and gets replaced. All right. Well, 5% is enough to make you kind of wince a little bit, but, you can take that, okay? Now, that 5% will be taken every year for 20 years. So once I do the QE, that harm stays in the system until it dissipates, and it dissipates at the same rate it accrues. But as it goes on in time, the problem becomes more acute because the first year it's 5%, then 10, then 15, then 20. Well, here's the problem with mortgage-backed securities. The average duration on mortgages is 7 years, okay? We all take out 30-year mortgages, but most of us move before the 30 years are up for one reason or another. Our kids grow and gone. We need a bigger house. We need a smaller house. We get a job in a different state. Whatever the situation is, the average duration over time is about 7 years. This is why the 10-year Treasury is the benchmark that more or less determines 30-year mortgage rates.
I did not
You'd say,
know
well,
that.
why isn't people ask, why isn't it the 30-year bond when it's a 30-year mortgage? And the answer is the duration on a mortgage portfolio is typically about 7 years. When rates are falling, it's shorter because people refinance. When rates are rising, it's longer because people don't refinance into higher rates, okay? You'd be an idiot to do that. So the duration changes a little bit, but it's about 7 years. So what's the Fed done now? The Fed's been doing this for about 4 years. So about half of the damage that is going to be taken has been accrued. And at this point, it's really hitting people hard. So they have to stop. And that's the bottom line here. That nobody's, the people on Capitol Hill in the House, most of them don't understand this. They've never understood how duration works in a bond portfolio and how people ladder bonds. But I will say this, because I've talked to senators and their staffs. They all understand it on the Senate side.
So they know the taper is going to be in, and they're going to be doing this taper right into according to what you're seeing. And
the Senate, Greg, the Senate knew this when the policy was first put into place, and has intentionally kept their mouth shut for 4 years.
Well, then this fall is going to be a disaster.
Well, I am not,
because
I am not
if that's what you're saying, and they have to keep doing it, then that's what's propping up the economy. And let's be clear.
I will say this. I am absolutely convinced on the basis of personal experience, not from what someone told me, okay, that the majority of the senators that currently are seated understand exactly what I just told you.
Oh, man, this fall is going to be a disaster.
And they have understood it since the program was first put into place.
Karl Denninger, this fall is going to, based on what you're telling me, and I know you don't have hard evidence yet, but based on the anecdotal evidence, and that they have to, stop this prop up of the economy, boy, I don't see how 2014 doesn't end in a big kaboom.
Well, you have today people in the Senate that know this, and yet if they stand up and say it, the government has to stop borrowing all this money that we don't have. The Federal Reserve must stop financing the government deficit because it's destroying capital formation and it is destroying savings. And oh, by the way, the world's a balance sheet, and for everyone who gets a lower car payment, someone gets less interest income. If anyone in the Senate actually stands up and says that in a Humphrey Hawkins hearing, okay, and nails Yellen with it, the market goes down 700 points in 5 minutes. So the reason it hasn't been done is because the guy who does it is going to get skewered, or the gal, all right? And unless you get a critical mass of people who will do it and stick to it, you could never pass that as policy. They know this, but they can't pass it as policy. The people in the House, hey, hello, Maxine Waters doesn't understand this. I'm not convinced Ryan understands this, but he ought to. He doesn't have the excuse of not understanding it, neither does Boehner. But I guarantee you somebody like Maxine Waters doesn't. And there are dozens, if not hundreds, in the House that have that handicap. The Senate refuses to sit down with the House leadership on both sides of the aisle and tell them, basically take out the chalkboard and explain to them and say, look, the longer you allow this to go on, the worse the outcome. This is going to be bad. It will be 100 times worse if we cut this crap out. Now, we can either take the risk of the wrath of the voters now, or we can potentially lose the economy of the country. And those are the only two choices. And then you let the party infighting go on and, figure out what you're going to do politically. But nobody's willing to stick their neck out on the block and do this. And so what you have is the same thing that happened in 2000 after the tech crash. Hey, let's find a way to reinflate things. And what was it? Houses, which was all fraud. So now what do we have? We have companies selling at 600 times earnings. All right? How? Well, because there's all this hot money flowing around, and it's got to go somewhere, right? So, well, gee, whatever's going up, that's what we're going to buy. That works right up until you can't make any money at it anymore.
So your call is, oh, they're not going to do about face. They can't. They're going to continue to taper. And just because you don't say anything, it's kind of like, Ayn Rand saying you can ignore reality, but you can't ignore the consequences of ignoring reality. It's going to happen anyway, isn't it? Isn't this blow up going to happen?
Yeah, Greg, look, if I look up and see a piano coming from the 50th floor of a building, all right, averting my eyes and looking down the street doesn't stop it from falling on my head. Right?
So you're saying that a piano is going to fall on the head of the economy?
Yeah, and the problem with bubbles is they always find pins. I don't know where the pin is, but they always find pins. It always happens because sooner or later somebody wakes up in the morning that has enough money that sits up and says, this is crap. All right? And they are the right person to do it at the right time. In 1999, it was obvious that we had a huge bubble in internet stocks, pets.com and all this other nonsense. All these companies making no money, selling it at ridiculous multiples to sales. And yet the market went up another 25% in the first 3 months of 2000. And then a little itty bitty company, MicroStrategies, they're still around, by the way, had they said, well, maybe we had a little accounting problem. Okay. And this was shortly after they had announced some kind of an acquisition or something. I don't remember exactly what the backstory was. I remember the announcement of the accounting problem. And all of a sudden, why it was that firm that caused everybody to wake up the next morning and say, this is crap, I don't think anybody will ever know. But that arguably is what set it off. And you know what? They were one little company out of all of these others in the NASDAQ, everything else. And all of a sudden, everybody goes to the door. The same thing happened in 2007, 2008. Everyone points at Lehman Brothers going down, right? But when you read the Valukas report, which went into the crash, right, of Lehman Brothers, the Valukas report says that Citibank factually knew that Lehman was bankrupt before anybody else, okay, by a couple of weeks. And the reason is Lehman went to them for a repo transaction, and they said, well, your collateral sucks. What else do you have? And Lehman said, nothing. Okay. And at that point, Citibank, their trading desk, their bond trading desk, factually knew that the company was bankrupt. But the market didn't crash that day. All right. It should have, but it didn't.
Karl Denninger, thank you for this is one of the best appraisals of Obamacare and then the overall economy. I mean, a piano falling on the head of the economy. You think it happens in 14 this year? You think it happens this year?
I think we're odds on for it. Yeah. I mean, is it possible we get through the year? Sure. Anything's possible. Bubbles always go on longer than anybody thinks they will.
But end of 2015, no. Does it go?
I don't see how we get through this ultimately because the Obamacare impact cannot be, other than just saying, well, screw it, we just won't enforce it at all, which
it's a de facto repeal.
Well, that would change things, but I don't know what the realistic odds are on that. I can't handicap that.
Ooh, how are you protecting yourself? I mean, if we're headed for a crash, you're going to be a giant shorter of the market at some point. Are you holding cash? Are you buying land? Are you holding? Evidently you're not going to be in paper.
Well, I think what you have to look at is what do you need, okay, and why do you want to be in the equity market on a broad basis? This is not to say there aren't opportunities. There's always opportunities, even in terrible markets. There's opportunities, but why do you want to be in the market on a broad basis when the market is priced for a continuation of earnings as a percentage of GDP, profits as a percentage of GDP, continuing to expand, all right? When it is at an all-time high and at about where the top of the historical band has been on a percentage basis from the last two oscillations that both led to significant downturns. Why do I want to be there? All right. That doesn't make any sense to me. And the other thing to keep in mind is that the government's borrowing posture is helped materially by a crash. Because it drives people into treasuries.
So
if
they
the
may
equity
want
market,
the government. You're saying, let me just get this straight, that the government may want a crash
not publicly,
because it would
but
drive
if I'm
people
going
into
to
the
sell,
treasury market and actually actual natural market forces. Even though what happened is not natural, but that crash would be the natural reaction to this crazyville we've had, and the government would say, "Oh, great, a 2% 10-year bond, yay!"
yeah, the problem with that is that if to the extent that it allows them to continue to finance what they've already borrowed, um, they'll look at it as good. To the extent that they turn around and they borrow more and rank up the borrowing even further, which is exactly what you would expect them to do, right, based upon history, it makes the problem worse. So there is, on the one hand, the political aspect of it is, well, borrowing's so cheap, we can go out and borrow all this money. The other side of it is you better not, and they will. So,
Karl Denninger, market-ticker.org, very popular website, and I know why. People love your brain. We love having you on for these interviews. Thank you so much, Karl Denninger, market-ticker.org, for joining us today on USA Watchdog.
thank you.